Welcome to Power Charting. I am your host, Bruce Fraser. Today's topic, is the stock market decline ending? For those of you that don't stay through the whole 26 minutes, I'll give you a quick answer. Probably not. And the near term could produce the conditions to start some kind of a causal structure for a stopping of the decline and a rally. We're going to talk about that today. Is inflation set to retreat? Probably so. We'll look at that. Our interest rates finished rising, potentially very close to the end of the advance for the time being. We'll look at that. Plus a very cool historical analog or two. And so let's get started. I have way more that I can do in the time that we have together. First, really happy to announce that we are going to have another free session of the Wyckoff market discussion to celebrate the 300th episode of the Wyckoff market discussion. Truly hard to believe. This is a celebration. Attend for free. Join us. Click on this little blue box right there to register. It's absolutely no obligation. We're just going to have a good time together. We just did one in early April. It was terrific. It was a really good event. You can watch that on demand right from this page. Check it out. We hope to see you on May 25th. First, the Consumer Price Index was just reported and it had a downtick. It was 8.5 as of the March reading. In the April reading, it went down to 8.3. Should we celebrate? Certainly not. It's not a good thing that inflation is so high. I'll show you why in a minute. But we had built this point and figure chart. We've been looking at it. You've seen it a number of times. The first objective segment here has counted up to the minimum 8.25 to 1188. Now, is it possible to get to 1188? Absolutely possible. We have gone to 8.5. We're in the area of the estimated range for the first part of the advance. Let's hope that's as far as inflation goes. The Fed is actively trying to fight that now. So we will keep an eye on that and hope that inflation can come back down. Now, my concern is this, that people are going to, in power, are going to celebrate if inflation can get down to the lower levels of 7 to 5, 6%, something like that. I have no idea where it could go, but that will be not a good thing. It needs to be below 2% on a consistent basis. We will watch this very closely. So here we are. Let's hope that these downticks continue in the months ahead. This is a Fed funds interest rate chart, which goes back to 2002. Here is the 2-year US Treasury yield. As of this chart is as of January 7th. And you can see here that interest rates were starting to go up at a pretty rapid clip, not followed by the Fed. The Fed sets Fed fund policy rates, and you could see that there was not an increase as it started to go up on the 2-year. So what has happened since? I'm going pretty fast because we got a lot to do today. And so you can see that in fact, let me clean this up, is we have now started to see Fed policy start to go up, and the Fed rate, this is as of May 6th, has now jumped to 1% right here. And so the Fed rate is on the climb. They are talking about continued higher rates in the future. They're talking pretty tough. So could we get something like this? We will see. But now the process has started. Are we pretty close to an interest rate high in here? This is a resistance zone. Well, let's have a look at that. But let's take a minute and look at the CRB, because the CRB, this is a relative strength comparative to the Nasdaq 100. And the Nasdaq 100 mega cap growth stocks have been going up since 2011. Persistency. See my most recent written blog to see more of these long-term charts. This one is not in there, but big buying climax occurred in 2020 in the NDX relative to the CRB. Thereafter, the CRB started to develop relative performance to the Nasdaq 100. And then in a complete outright breakdown after what appears to be distribution out of the trend channel, downward it goes, showing that CRB is, as an index, outperforming the large cap growth names, which is the first time that this has happened since 2011. And the declines that have occurred have been quite shallow. Now it's substantial and probably represents the beginning of an important trend towards commodities. I'm going to talk more about this phenomenon. I think it's very, very important. I think there's a lot we can discuss, a lot that we can gain from reviewing this and reviewing the industry groups that reflect the commodities and the industrial stocks. We'll do that possibly as early as next week. So here we go. And you can see this is what has happened since, just to bring you up to date. And it's just continued to persistently drop, and it continues to be quite oriented towards the commodity prices as it just continues to go ever lower. And so this is a very large structure, almost 2 years in duration. Now, I put the put call numbers in here so that you could see that there was extreme pessimism in this area of 2011, 2012, when the final low was being put into the growth stocks at that time, which kicked off a mega advance, secular advance in these stocks. Well, look what happened after, and I really emphasize this, after you had that climactic buying climax blow off in the Nasdaq 100 names relative to the CRB. And you can see that it was only after that happened that there was this extreme call buying activity in the stock indexes in the individual stocks in the call volume, and it shows up in this ratio. As the rotation is occurring, speculators were really leaning the wrong way as the blow off was occurring in the Nasdaq growth stocks. The emphasis needed to be on these material stocks, and therein lies the problem with being a speculator. Okay, so here is the CRB again, and it is matched up to the US Treasury 10-year yield. And the decline in the 10-year yield has been going on for a substantial period of time. This history goes back to 1956. This is 1987 right here. And there is just a secular decline, really since 81, a secular decline in interest rates throughout that period. Well, look what's happened here. You have all of a sudden a change of trend, a change of direction. This chart, and I've showed you this chart in the past, this is actually through May 10th, so just a few days ago. And you here see the CRB. This is just the CRB index, and it's just on this upward run. Well, compare that over here to the run that took place in the early 70s. The first leg up in commodity prices after being range bound for, call it 15 years. Well, interest rates were already rising in this period of stable commodity prices, and then they started to really ramp. This ramp is reminiscent of this ramp here. And so these two ramp upwards are occurring, and interest rates are really slow to follow. Very different from what happened back in the 50s and 60s, I guess really the 60s and 70s, as rates were already starting to trend upward and higher. So what has happened since? We can see here that The interest rate on the 10-year is now in the area of 320. And you can see here, it's up into this resistance zone. The highest print we've had on the 10-year yield is 305. We are definitely in the range of this objective that we have been talking about and studying that goes all the way back to 2019. And so we would look for this to stop the advance. So I believe this means that, at least for the time being, that the Fed is very close to ending their rate hike scheme. There may be another 50 basis points out there. That's just a guess. But seeing that, you can see that there's major resistance. If you look over here on the lower right, across this green line, that's major resistance at this 305 to 320 area. And it may actually be producing a bigger cause for a bigger rate increase at a later time. But I suspect that we could very well get some kind of a pause, maybe slightly above the resistance area, but a pause that could last potentially months and months. So the Fed is probably a couple of quarter point hikes from being done for now. Here is the S&P 500. This is a chart from that written blog that I just did. The point I want to make with this chart that's so important is that we became overbought here in late 2021. You can see that overbought, throw over of not only the trend channel, but also the Keltner band. I like the Keltner bands a lot. You can see how well they work through this area where it became overbought, could not continue to stay above that area, and then started to fall. We've been documenting this distribution area, but you can see here that this is, I said at the time, not only related to this trend channel, but others in the big indexes, that once you come back into the channel from above, you can fall really sharply and quickly. And in fact, you could see that back here. You can see it over here. You see it here off the Keltner channel, here off the Keltner channel, up here, touching two overbought conditions. And now it's falling very sharply and getting pretty darn close to the lower channel. May or may not stop it. We'll have to look at other indicators to be able to tell whether or not this is in fact over for the time being. And so let's go back and continue on. This is the Dow Industrials. You can see here on this 60-minute chart that there's a rather large distribution structure. We've looked at this in many different ways on different indexes in the last few months, but here is some counts that I would like to show you. Here is a small count at the top, this distribution area here, which goes down to the area of 30,547 to 28,956. Now, this is an area that we are pretty darn close to at this time. You can see here, as of 5/12, we were at 31,548. My understanding is we're down about 400 or 500 points in the Dow today on the 12th. So this number is lower now. So here's another count, and this count is from the last point of supply rally that we had, this count to here also. And this count takes us down to 24,500 to 22,910. And so there's two rather substantial distribution counts. This one is very close to being fulfilled right here. And if we take this little green box that we have, this green box actually counts to one above these two count points here. So this is a stepping stone reconfirming count of this count right here. And with that, we can see that we're pretty darn close to potentially some kind of an area where stopping could take place, building a cause. That's the reason I asked that question in the opening slide, but we have to look for other evidence to support that. And I don't think we have that yet. Here is literally a 5-minute point and figure. These are terrific. This is ATR scaling, 3-box reversal. This is a structure that was built in March March, the first 2 weeks of March, and it produced a count that was just absolutely spot on up to this point here. Now, and there is the count area objective range. Now, let's look at the distribution count that formed on this bear market rally leg that we just completed, and now we're having a persistent decline off of that. And this decline, we're calling this an LPSY, last point of supply. This count here counts down to 31,716 to 31,050. I think we're probably getting pretty close to that 31,050 level as we speak. We were at 31,548 this morning. So we're in the range. Now, can we go through it? Absolutely, we can go through it. Does this mean there's an imminent rally coming off of this? No, things needs to happen. We need to have a cause built, a structure of sorts, divergent characteristics internally in breadth and so on. And so we will be looking closely for that. Now, this chart is a historical chart. January 14th is when this, the last date on this chart. You can see the upward stride. At the time, I warned that we had 4 touches of this trend line, and you could see the distribution with an up thrust in the S&P. And the S&P has a stronger structure than does the Nasdaq 100, triple Qs, etc. And if we have time, we'll look at that. Well, let's bring this up to date, because we can see here the notes we took at the time: up thrust character, supply present, failed test, which is right here, higher lows throughout, 4th touch of the trend line. Often when you get a lot of touches of a trend line, it produces a drop. It says it wants to go through this area. Supply is present as defined by high volume on the down days, etc. And so what happens since? Here is an update of this area. This trend line was right through here. Look at this decline. This set up a sign of weakness. Now we've had 2 LPSYs at the time. Now this chart's been brought up to date through the 12th today, and now is probably lower than this in this area, below 4,000, by the way. And and we had documented the case here for a rally with these green shoots, and actually did it right when it was breaking out of this downtrend. And we did, in fact, get the best rally of the year right here in this phase, which set up an upthrust of this area and a failure. And you can go back and look at earlier power chartings and also read about it in my written blogs. So with that, let's keep going. So triple Q, this is interesting. So again, proxy for the Nasdaq 100. Here is this, this is a daily chart. This is 2022. You can see just the cascading decline off of the end of the year, which is a classic moment of the importance of quarter ends and year ends. And down we went, built some green shoots in here for a more important rally. This is counting that area of the redistribution. What does that count? Well, interestingly, that count is 300 to 276, 1 box reversal, traditional scaling. And so here we are down in this area for a drop to 300 from 368. And then I took the midpoint, which is the dotted line. 276 is the midpoint because we don't actually have a count line that we can count from. So we just take the midpoint. And today we are in the area of I think we were around 285, 287. So we're right in the middle of this zone right now. So is that a reason for a rally? Absolutely not. Same rules apply. Have to look for some internal evidence of positive divergent character. We need to have some kind of a climax, automatic rally, and then some kind of a causal structure build, even if it's a V bottom. So, and then also, let me just say here, look at this beautiful upward thrust in late March, climax, and then there is a test and a failure. Look at this trend channel drawn off these 3 points at the beginning of this move. and then downward it goes. And I'm asking the question, is this what we're getting now, a climax and a throw under of that rather small channel? This is a 2-hour chart. So something to keep in mind. Now, this is the semiconductors. We know semiconductors are important because they are the speculative preferences of many traders. And we can see that we're getting actually very close in, this is through the 11th, and we were down to 219 over here. And we are, oh, the last time I looked today, 215.48. So here's our count objective, 219 to 213. This is off of a count. I actually published this in February. I think I showed it here on Power Charting, definitely WMD. And so you can see this beautiful distributional count structure, 3-box reversal, 3-point scaling across here gives us this count. So this also represents the area of prior support. This could be a place where we get some sort of a stopping, pausing, bouncing, as we discussed before. Do the semiconductors, are they likely to return to leadership? I think probably not. I think that any rally attempt in the market in here is going to be an opportunity for institutions and others to continue to raise cash and sell stock. Now, with, oh gosh, 4.5 minutes left. So with this, I have a very cool analog to show you. And this analog is the 1917 to 1920 Spanish flu, which I'm comparing to the COVID pandemic markets. And so the thing that you're looking at here is a Nasdaq 100. So I think the Dow stocks were much more of a growth kind of smaller cap element back then than they are today. Much more of a, I mean, they were the blue chip stocks of their day, but they also were in the, you know, phases of the Industrial Revolution. So what I did is I counted off from the low to the high. Here is the time, the date, or the area of the actual recording of the first outbreak, which occurred at Camp Funston in Fort Riley, Kansas. And this was on March 11th of 1918. The illness had to be incubating well before that. And so note that there's a very important rally that kicks off of V bottom here. That in fact is what we saw happen back in 2020, a V bottom low, and then a very sharp advance, very persistent, 685 days trough to peak in the industrials to the peak here with the Spanish flu 1917 to 1920, 2019, 2022, this chart 606 to the first peak, 645 days to the second peak. And so you can see that there's very much a commonality in the duration of time spent between these two periods. Okay, and now let's look at the 1917 to 20 period to the 2019-2022 period in the Dow Jones. So here you can see that what I did is I showed trough to peak in the Dow. This time is 652 days to this peak right here, 685 days again for the Spanish flu. Look at this large distribution structure through here, which we have talked about endlessly. Look at the distribution structure in the Spanish flu period. They're both just classic, very large. This is arguably more volatile than this, but they are both rather large and ominous looking, which produced this decline. Well, what happened next? So in a minute and a half that we have, here is what happened next in 1922 is that you can see, well, this is actually a 1919 top. Here's the distribution. What I've done is I've actually labeled my interpretation, Wyckoff interpretation of this distribution structure, showing the decline and the deep fall off. And you can see there's these very sharp, short rallies. And these rallies are very hard to catch even today. They're very difficult. I don't recommend trying to catch bear market rallies. And so just a warning about that. So we may get, and we will continue to document it. We're going to watch this market very closely. But look at what happened in 1922. We had a return all the way back down to the lows that occurred in 1917, wondering if we could have that kind of a decline that takes back all the gains from the COVID low in this particular environment. So far, the market is acting like it's definitely for sale. It's going to continue to just work its way lower and lower and lower. And this is maybe a model that we can look going forward. And with that, I'm getting very close to the end. Look at the labeling here for this base that produced a very, very good rally thereafter. And with that, I will say so long. Thank you so much for being here, and we'll see you next time.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.